Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacqua. Over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. Shot in the arm, stock ETFs listed in Europe have already had their best month of inflow since January on hopes of a post-COVID return to normality. Equities could overtake fixed income by the year-end. Ethical investing for universities and their multi-billion-pound endowments, while we speak to asset manager Amundi as they launch a carbon-free global equity fund. And it's the biggest company ever to be added to the S&P 500, but plugging in Tesla is causing $400 billion headache for index tracking funds. We'll bring you the story. Well, first up, let's discuss some of the week's flows. Buoyed by news of 2 coronavirus vaccines, Europe-listed equity ETFs are on course for their best month since January. Stock funds have seen more than $5.7 billion pour in over just 2.5 weeks. Now, that compares with $1 billion of inflows for fixed income. According to Bloomberg Intelligence, seasonal momentum could push equities ahead of bonds for the year as a whole. Well, joining us today is Michael John Lytle. He is Chief Executive and Founder of Tabula. Thank you so much for joining us. MJ, what's your take overall about the direction of ETFs from now until the end of the year?
Well, thank you, Francine. There's no question that equity flows are catching up with fixed income, but we have to put this in perspective. Over the sell-off in March and April, both markets saw 15 to 20 billion of outflows. Fixed income within weeks started to see inflows and has outpaced equity inflows throughout this year until today. Equity inflows didn't really restart until June, so there was a 2-month gap between April and June for fixed income and equity. Equity is catching up and now matching fixed income, but remember, historically, we had double the inflow into equities of fixed income. So to match past flows, you would actually have to see equities make a massive gain over the next month.
Jay, I mean, could we see those massive gains? And if, we don't, what could be the catalyst if it were to happen?
Anything could happen, but, here we are on November 18th. We've got about a month until markets start to close down, people close up their books. I'm not sure there's the risk appetite for people to significantly increase their equity positions. In general, I would say people are looking at the year end and starting to worry about year end liquidity, starting to think about how to protect any gains that they do have in their portfolios. I think in general, we're going to see people repositioning between their various risk positions, but highly unlikely at these levels, which are elevated. Remember, we are at levels both in the fixed income and equity markets, which are beyond where they were before the sell-off in March. And so people are already pretty heady in their expectations of where the markets are and where value is. So I think I think the market in general will be surprised if there were another massive inflow into risk assets.
MJ, I don't know what you make of Bitcoin, or if there's a way to trade Bitcoin through ETFs. I mean, what's the impact on certain ETF markets in Europe because of the rise of Bitcoin?
Well, I think Bitcoin is interesting, but it's interesting in what it says about the need for cryptocurrencies. I think the much more interesting story is going to be what the central banks do around introducing central bank digital currencies. That's really where the story is. The use of blockchain technology by central banks to create electronic versions of their own currencies is going to produce a much bigger impact on how people use currency going forward than I think the private sector solutions in the digital currency space. We've already seen China, for example, kicking off a project to create their own digital currency for the renminbi.
Do you worry about liquidity in ETFs, and what kind of trend will that actually put? Is it liquidity, for example, in cash bonds that can no longer be assured?
Liquidity in ETFs, basically, as we know, comes from two different things. There's the secondary market liquidity for the ETFs themselves, and then there's the primary liquidity, the ability to create new ETFs, to pass through the liquidity of the underlying assets that the ETFs track to the end investor. What's most important to underpin liquidity is what actually goes on in the primary markets, and that means how liquid are the assets held by the ETFs themselves. This is something that has caused concern over time with fixed income assets. Obviously, fixed income assets are not liquid in the same way that equities are. It's partially because the fixed income asset class is far more diverse, has a far larger number of securities. Remember, there are about 70,000 listed equities. There are 9 million fixed income securities. And this is an OTC traded market as opposed to on exchange. Having said all that, the fixed income ETFs performed extraordinarily well through the crisis. ETFs showed that actually they were a source of liquidity and access when the market sold off. So I don't think there are any concerns about the liquidity that you can achieve in the fixed income markets if there is another sell-off or into the year end. And actually, I think most people see ETFs in the fixed income space as providing greater liquidity rather than drawing down liquidity.
All right, thank you so much. MJ Lytle there from Tabula stays with us. Now, coming up, we'll have plenty more on ESG. How do universities also ensure their multi-billion-pound endowment funds are ethically invested? We speak to asset manager Amundi, who today are launching a carbon-free global equity fund. That's coming up next with our Danny Berger, and this is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, ESG funds have been one of the biggest growth areas for retail investors in 2020. But how can universities ensure that their endowment funds are invested ethically? Well, to address the change, asset manager Amundi, working with colleges from Cambridge and Oxford universities, are today launching a carbon-free global equity fund. And our Danny Berger is at Amundi with an exclusive interview. Over to you, Danny.
Thanks, Francine. I'm really excited to bring the story exclusively to our viewers. One of the first times these two prestigious UK universities are endorsing such a passive tracking green fund. And joining me to discuss is Ashley FAGAN, head of ETF indexing and smart beta strategic clients at Amundi. Ashley, first off, thank you so much for joining. So looking at some of the specifics of this fund, so it's going to replicate the MSCI All Country World Index, strip out any fossil fuels as well as any controversies seeded by Clare College at Cambridge University. So what was the thought process behind having this track the performance of the All Country World Index versus just a pure exposure to green companies?
Hi, Danny. Yeah, we're really excited about this fund launch today and being able to partner with such world-renowned institutions. This fund will address the financial risk of climate change, and it goes a step further compared to most products that are available out there today in terms of completely removing the energy sector. Thus, it addresses the risk of both stranded assets as well as companies that have direct economic exposure to fossil fuels. So using an index tracker fund was a way that the college endowments at Cambridge and Oxford were able to address the specific requirements and objectives around ESG that they wanted to integrate.
So it sounds that this will then replace the equity exposure as a whole, that this will be sort of the new core exposure. Is the idea then that this would outperform over time versus just a plain vanilla equity fund?
Yeah, I think it's a really interesting point that you bring there in terms of we're really seeing ESG become mainstream. It's replacing the core of portfolios now. It's not just, niche thematic sitting in a very specific ethical portfolio. So indeed, these clients are looking to replace their equity portfolios and move to this low carbon solution to address all the financial risks that we discussed in terms of climate change and these exposures that over the long term can have an impact on performance, as you say.
So an impact on performance, but what about an impact on the company itself? Because this is a passive fund, were there any concerns from these endowments that they maybe couldn't have as active of a discussion with the companies or an impact when it comes to sustainability?
Yeah, it's a really, really common misconception that we get that if you're investing passively, can you have an active approach in terms of voting and engagement and influence with companies? And in fact, it is not true at all in terms of active stewardship. It's not passive or active. So at Amundi, for example, we have a very active voting and engagement policy that applies to all the portfolios, regardless of whether they're managed in a passive or active way. And actually, if you look at the amount of index assets managed globally, this has the power to be a very, very large voice and have a really big impact overall.
So have these endowments asked you then on their behalf to be more active with these companies to promote those sorts of things?
We already have a very active voting and engagement policy, but we are looking to collaborate and, for example, the universities do a lot of research in this area, and I think there is an opportunity for us to really partner and look at best practices in terms of engagement and voting with companies.
So iShares also launched a somewhat similar product last week for Oxford's endowment as well. Is this a space that you're seeing a lot of competition? How hot is this sort of arms race now for endowment assets?
It's a really good question as well in terms of, absolutely, it's been a remarkable year in terms of new product launches, especially on the ESG side. We see a lot of growth in passive. We really welcome competition, and it's being driven by demand and by innovation. So these are things that are really positive developments for everyone.
So what's the thought then in getting beyond endowment money for this? It was seeded by one of the college endowments. What's your plan for attracting other institutions to this fund?
I think the really important thing about ESG, there's two things. One is we're really in the middle of an ESG revolution, and Europe has been a leader when it comes to ESG. So at Amundi, we've been one of the first companies to really take responsible investing seriously, and we developed the first low-carbon indices back in 2014. Those are available in ETFs, so anybody, all types of investors can buy them. But it's really important that with ESG, it's not a one-size-fits-all approach. So you have off-the-shelf, ready to buy ETFs in ESGs across different intensities. You have climate ETFs and index funds available for investors, but you also have the opportunity where some sophisticated investors may want to incorporate really, really specific ESG requirements or objectives, like in this case, where we're completely excluding the energy sector, in addition to many other factors. And that nature allows us to work with those kind of clients to develop more customized solutions as well.
So more customized solutions, and you mentioned the off-the-shelf as well, but certainly there are already a lot of strategies out there. ESG is so popular, especially here in Europe. What do you see as left? Where are the gaps that you would like to fill in terms of building out new products for Amundi?
I see there's really three main areas where there's still space for future development in this area. One is around more granular exposures. So if you look at the broad indices, MSCI World, MSCI Europe, of course, there are a lot of ESG products already available off the shelf, as you say. However, if you look at things like single country ETFs, there's less availability in terms of those products. For example, we've just launched a UK SRIX fossil fuel ETF. I think we'll still continue to see more of these types of products launched because as asset allocators look to replace their core portfolios with ESG building blocks, they need these exposures as well as the larger indices. There's also fixed income. So this year has been a huge year for equity ESG, but I really believe that fixed income will be the next big transition. And the third area is around thematics in ESG. So there's still a lot of innovation in the space. There's a lot of active funds, but there's not that many actually thematic ESG ETFs. And I believe the climate theme will be a big topic as well going forward.
So with these asset managers who you've had these conversations with, be it thematic or fixed income, have you had a lot of people come to you looking at seeding more funds like you've done with Cambridge?
Yes, absolutely. So the demand both for the existing product range, which we've extended and is available all across in terms of if you look at the broader ETF range, there's a lot of different, let's say, flavors of ESG or ESG intensities that are available to suit all kinds of investor needs. Right. But as mentioned, you do have more, because of this, it can be quite a complex topic when you look at things like maybe improving specific carbon emissions or very, very specific exclusions that investors might have demand for. So from that perspective, we are having a lot of conversations with investors around developing bespoke solutions as well.
Right. Well, Ashley, I'm afraid we're going to have to leave it there. Thank you so much for joining us. That's Ashley Fagan, head of ETF Smart Beta and Indexing Strategic Clients. Fran, it sounds like we can expect more of these types of ETFs to come and more institutions looking to seed them.
Danny, thank you so much. Danny Berger there with a great conversation at Amundi. Now coming up, it's the biggest company ever to be added to the S&P 500, but plugging in Tesla to the US benchmark is causing quite a headache for index tracking funds. That story is next, and this is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua here in London. Now, there's a lot going on the markets, and this was a big week, certainly, for Tesla. It's the biggest company ever to be added to the S&P 500. But plugging in Tesla, worth more than $400 billion to the US benchmark, is causing quite a headache for index tracking funds. Adding it all at once would mean that they need to sell more than $40 billion of stocks and other constituents to make space. Now let's get more with Sam Potter. He's a senior editor at Bloomberg who oversees our ETF coverage. Sam, great to speak to you. How does an index provider even start to approach an addition of this scale?
Good morning, Francine. Yes, well, what we have here is the financial market equivalent of that old joke, how do you eat an elephant? And the answer is one bite at a time. S&P Dow Jones have tried to be prudent and sensible when it comes to adding Tesla. They have waited until the company fits certain criteria. The problem has been that in that time, Tesla, which was already big, has got even bigger, so big that its impact on the index is going to be huge. It's going to be probably one of the top 10 companies, probably worth more than 1% of S&P 500, probably equivalent to more than 50 or even 60 smaller companies. And so their answer to that is basically they are seeking feedback from the investment world on adding Tesla in stages. Now, they said in their statement, I think 2 stages. We'll have to see how that goes. But basically, even adding it in 2 stages, it's going to be a very big change to the index.
Sam, adjusting the index is one thing. It's also not easy for the funds following the S&P, right?
Yes, absolutely. Well, this is actually the crunch. This is the problem. Adding to an index is really just changing some numbers on a bit of paper. I mean, it is fairly straightforward. There are criteria and it's mathematics and the way it works. The crunch is $11 trillion, something like that, tracking or benchmarked to the S&P 500. Each of those funds, if they're going to add Tesla, they cannot just sell one company. There's no companies that are going to exit the gauge that are big enough to do that. So funds have been planning for this for months. They've been strategizing. It's still not obvious what the solution is. We're going to have to see if Tesla is added in 2 chunks. But as you mentioned in the intro, it's going to be more than $40 billion worth of stocks going to have to be sold, going to change hands just to make room for these.
Sam, thank you so much. Sam Potter there, who leads our, of course, ETF coverage in Europe. Now let's get more thoughts from our guests this morning. We're back with MJ Lytle. MJ, when you look at Tesla, I mean, how much of a headache is this, worldwide? But what does it specifically mean for ETFs in Europe?
Well, inclusion in large cap indices is, and rebalancing them is a little bit arbitrary in the sense that, we have cutoffs. So the S&P 500 has 500 names in it. It has a rebalancing frequency. And so it means that if a company increases in value very significant over in between rebalancings, it can come in as a big chunk. Bringing in Tesla will obviously have a big impact on the overall distribution of the S&P 500, the sectoral distribution, as well as the individual name distribution. On the plus side, the equity markets are very liquid and have tight bid offers. And so although people will talk about the problems of rebalancing, the actual cost of selling one equity and buying another is relatively small. It does, though, continue to highlight the impact of tracking indices that are market cap weighted, that have specific breaking points, and whether these indices are always going to produce the outcome that people expect.
MJ, when you look at some of the things that we're looking at in climate and the Green Plan, the UK this week announcing a pretty sweeping Green New Deal, saying that it will support 250,000 jobs, and they're also banning sales of diesel cars, or at least of gas or fuel cars, from 2030. Is there a read across to ETFs? Are we going to see much more ESG products from the climate space in ETFs flourish?
ESG is the story and will be the story for the next decade in investing, because the financial markets, as the UK government has highlighted, Rishi Sunak has highlighted, are where a lot of the work has to be done in implementing the investment that is required in order to support the government's objectives. There is no question that the flows into ESG this year have been huge. They've been predominantly into equities because fixed income is a laggard. Only 18% has been into fixed income at this stage versus the normal footprint of 30%. It's very interesting, the different dynamics of investing in equity versus fixed income if you want to have an impact in ESG. Equity is very much a buy and influence market because companies are very rarely in the primary markets issuing new equity. So therefore, you need to buy their equities and then vote in the annual meetings. In the fixed income space, companies are in the primary markets on a continuous basis, financing themselves. And therefore, you vote with your feet. And if you stop offering money to people in their next bond issue, it will have an immediate effect on their ability to finance themselves and therefore have some pretty big impact on their decisions. So both equity and fixed income investment in companies based on their ESG characteristics is very important. I think that the way you engage is different, but the key is going to be a move from sort of screening approaches to much more impact-focused approaches where you're trying to produce an outcome.
MJ, thank you so much. Michael John Lytle there, Chief Executive and founder of Tabula. Now that's it for this week's Bloomberg ETF IQ Europe. We'll be back with more next Wednesday, 9:30 a.m. London time. This is Bloomberg.